You read his book, How to Trade in Stocks, which was written in 1940, but it was describing principles he was using in the early 1900s. Sort of timeless principles of what drives stock prices and where do the biggest winners come from. So that's really what we're looking for, studying these past precedents, and then just assembling. Again, we're taking a wide sample, calling it down, and so you learn how to spot certain characteristics, but then also you tend to get a decent feel for overall market health. I often tell, most people don't believe me when I go, look, I aggressive long side trader at times, but have not been caught in any of these major bear markets and declines we've had over the last 15, 16 years. It's because the stocks give you a lead on all that stuff. When you learn to do that process well, and that's even something I try and educate people in now, because the little guy has a tremendous advantage over the major fund or institution that has to move tens of millions of shares or hundreds of millions of dollars, where the minute there's certain signs that sort of show up, you can raise cash and get out of the way, if you will. Yeah, the general process though is that screening process first. Then we take any ideas that we think are closely buyable, put them on separate watch lists, and it then becomes just a matter of then gauging the price action in real time. In terms of our read comes from, and any good market call I've ever made and that kind of thing is not because we're looking at magic indicators or anything. We don't even have any of those. I don't think they exist personally, but it just comes from running that process over and over and over and over again.
So you said you don't look at indicators. Do you look at fundamentals at all? And as far as technicals, kind of what do you look at if you are not looking at any indicators?
So what I mean by indicators is, I don't classic sort of technical indicators, stochastics or RSIs and MACDs. I couldn't even tell you what most of those things are. Again, I want to be clear. I'm not trying to be disparaging to people who use them. I just haven't found it to be helpful in terms of what we do. If you just gave me price and volume, that's really all I need. And as far as the technicals, now to answer your question about fundamentals, yes, we look at earnings and sales in the most recent quarters and margins, and then we'll look at the industry group, of course. And this is where you just see themes, where you can often and one of the every screen we run in the for how to. What this stuff is based upon, but so those are the fundamentals we look at. And then there's certain in the market itself. So in terms of fundamentals, I like the classic growth groups where the biggest winners come from is another area. So if those areas are acting well, say, versus other areas in the market that maybe aren't as sexy, or safe haven trades, things like tobacco and insurance, or classic the food sections. When those are setting up or acting well, that usually tells me that there's not a big risk appetite out there, because why institutions are going there to hide, they're not, versus other areas of the market. So, but again, a lot of that comes from when you run through that process enough. You get a really good feel for where the money's going. And this is where we tend to be agnostic. When people are like, what stock do you like? It's like, I want the stock to pick me. I don't want to pick it. And I'm going to do that based upon, if it's coming across my desk in terms of the routine regularly, and it has a bunch of these, criteria in terms of how it's acting, that's how it picks me. I don't go the other way around, where I draw up a thesis or look at valuation and then decide, I need to buy this stock. It's completely the opposite.
So do you look at market flows into different sectors, like you mentioned, tobacco, or say certain conservative sectors, to see whether there's a market regime change going on?
So I don't track that in terms of like where I have an indicator. This is where, so one of the screens, we like a lot is just we look at the top relative strength names just on that basis. And relative strength meaning relative to other names in the market, not relative strength index. A 52-week relative strength, say, how is this stock holding up versus everything else in the tradable universe? Well, that will tell me then if I see certain groups in there, why are these holding up relative to other areas? But I'm not necessarily looking for where's the money flowing right now. I'm saying, hey, well, the relative strength will eventually tell me that. It's almost like casting a wide enough net where I'll catch that stuff and then I can kind of cull through it as we go. Does that make sense?
Yes. Yes. Tell us about the necessity of building a plan, because in one of your other interviews, you're quoted as saying, a bad plan is better than none. So what is an example of a bad plan and perhaps even a good one?
Ooh, yeah, really good. Great question. And yes, that is something I think I've said is a bad plan is better than no plan. And a bad plan you follow is better than a good one you won't. Or I think it's kind of how I've said it. And the way I just think about this, look, Ian, think about it in terms of a different endeavor. If you and I are sitting down to play chess, and I know nothing about the game, and I'm just moving pieces around, and you know very little, maybe it's not even a good chess strategy, but you just stick to it. Odds will be you may not beat me every time, but you'll probably beat me over the long run if we play 10 games. You know what I'm saying? Mm-hmm. And most people don't think about that too, in terms, the reason I bring up that, even the game analogy. You and I play in chess, I have no strategy and I beat you, and you have a strategy and you lose. So do we conclude that I'm a better chess player? I would say no, we need to play 10 times. Maybe we need to play 50 times. And then the reality is in markets, that's what we have. You don't have one trade, one investment, one idea. You're going to have lots. And what really separates people is not the one right now. And too many people obsess about, was I right or wrong today versus was my plan good? And if I continue to enact plans like that over time, where am I going to be? And again, all forms of speculation or probabilistic anything. You know, if you and I flip a coin and I say, look, heads, I pay you $1.05, and tails, you lose $1. If we flip that coin enough, the edge is tiny, but if you flip it enough, you're going to wind up ahead, right? You follow me on this, right? But I think this is really subtle, especially then you add emotions and other things on top of it. How many times you hear somebody saying, well, that strategy didn't work, and they tried it, I don't know, or they listen to somebody like me and I give them, I like this idea, and they get stopped out. Oh, that guy doesn't know what he's talking about. It's like, do it 1,000 times and tell me I don't know what I'm talking about, or whatever it is. So your question was what's a bad plan, or was it what's no plan?
Well, yeah. I mean, how do we know if a plan is a bad plan, and what indicators are a plan is a good plan? Because wouldn't it vary depending on the market regime that we're in?
Certainly. And obviously we're getting more nuanced and keep in mind, my initial comment is because what do a lot of people do? They just open up an account and start buying stuff or shorten stuff. I mean, they don't have any plan, right? So, and even the idea of seeing your process where there are certain firm guardrails that you are not going to deviate from. Risk management has to be the bedrock in terms of, okay, so for starters, not knowing what you're going to risk in anything is by definition a terrible plan. So somebody will ask me, I bought this stock, what should I do with it? How in the world should I know? You should have known that ahead of time. That there's a class. I mean, you and I could probably I've never come up with like a list of 10 commandments for a bad plan, but no risk management would be one. No context for sizing. If you have no risk plan, then you're going to have no sizing plan either. How would you know how to size the trade? No exit plan on for profits is another one. I mean, there's a couple of things. I'm focusing on exits, but even the idea of, is whatever you're doing repeatable by definition? And why'd you buy this? I saw it moving, I grabbed it. It's like, well, what was that? Is that a plan, or is that just, you're just decided, well, I chased the shiny object? And people don't understand this either. And it's an important point. You can trade everything from a phone in your pocket now, multiple markets all night long. I mean, you're being bombarded by stuff. So to be able to take that world and narrow it, is really that is the hard part, I think, for the modern trader, where 40 years ago, you didn't have access to as many markets. And if you had call brokers, and even then, it's like the executions were delayed. And if most traders traded, one or a couple markets, or you had to go into a pit somewhere. So it's finding how to make the world smaller, if you will, and where you're able to ignore all that other, all these other things that are going in any one day. Now, so the example of a bad plan, like I said, would be, anything based upon emotion, anything based on non-timeless principles, or where there's no positive expectancy, historically speaking, I would argue is a bad plan. You're just gambling. Most people don't like hearing that, but the reality is a lot of your modern retail traders, in my opinion, are no better or no worse, depending on how you look at it, than someone walking in a casino. They're buying and selling and trading for other reasons than really to make money. That's a whole nother road. But so, yeah, anything you're doing based on sort of non-discipline, and then specifically non-historically really good principles, I would argue is a bad plan. And then specifically, like I said, nothing to do with risk or not thinking risk first would be an example. Now, here's another example of at least a bad plan for me, or something I don't do. But let's just say, hypothetically speaking, you've got a plan to buy something and then average down. I don't believe in averaging down. I don't do that. However, I still think if your plan is, okay, I'm going to buy something and I'm going to buy a little bit more if it stays in a range, maybe I wouldn't just blindly and then stop out at a lower level. Well, there's a plan I think is a bad plan, but at least you have a plan and you have a spot where you're going to get out. Maybe you're trading something in a range, you'll buy it as it comes down, and then as it goes back up, you'll scale out or whatever. I mean, there are people who make a living trading and doing it that way. I don't. And so there's an example of a plan I would never use, but I think as long as you stick to it and follow it, versus the guy who has got this massively intricate plan, so much so that he doesn't follow it. I'm going to buy this as it breaks out, and then it gets up this high, I'm going to sell a percentage of it, and then it pulls back, and he's got 25 steps to his plan. And then once he's in the heat of battle, he doesn't really follow any of them. So that would be my example of maybe a really good intricate plan, but someone can't actually, stick to the discipline and execute it.
So when talking about entries, how do you define and quantify a low risk entry? What does it look like? Maybe even from fundamentals, if you're using it, or how would that look like on the charts?
Yeah, it's pretty simple in terms of the charts. And as far as the entries are concerned, so I may want to get involved because of the fundamentals, but in terms of the actual timing and execution of trades, it's always going to be because of the technicals, or I'm looking for technical confirmation. And there may even be situations, where my technical work, someone goes, well, that doesn't look, as low risk or whatever. But I still there's going to be some non-negotiable technical criteria. But the really short answer is I want something in a long-term uptrend. And then I'm looking at defining that based upon the weekly chart and sort of, or maybe something like the 200-day moving average. And then meaning those are going to be in uptrends. So I'm never bottom fishing. I'm never, picking things off 52-week lows. I don't even see those names. So when someone usually, what do you like about XYZ stock? If it's not in a long-term uptrend, I won't even see it. That's one of the ways I'm culling the market down. And then I'm looking for really the best way, again, in a very short form, is a tight consolidation or pivot point where I can know in relatively short order if I'm right or wrong. And for me, short order is days, a week or two at most, because I'm looking for efficiency on my capital. I want to know relative. I don't have to sit around and wait to find out if something's really under accumulation or if the story's really, however you like to think about the other things. I often like to say, if the story's so good and the fundamentals are so great, why isn't the price corroborating that? I'm a big believer in that. And especially for folks, this is a really highly underrated idea, in my opinion, that efficiency of capital, because it's a huge market. There's lots of things, especially it's a huge global market, but even the U.S. I'm speaking broadly, the U.S. equity market. There's just so many ideas. So I would rather get efficiency on my money and turn that edge over. And it's just I found a much better way, especially for smaller accounts, to really outperform. If you learn how to do that and do that well, it takes time, effort, skill, and discipline, but it's something that can be learned. So.
What do you look for, like in the charts of if you get a buy signal on a stock and you go in long, how long will you hold that? Say if it stalls out, and you talk about efficiency of capital, and say the move doesn't follow through the way you expected, but it's not drawing down to say your stop loss, and it starts to go sideways. Do you have a certain time period that you look to give it a chance before you just dump it just because it kind of stagnated and then move on to the next pick?
Yeah, so I would say, and it depends. The short answer, though, is if I'm at a multiple of risk, and this is where I'm always thinking risk first. So like you said, it stalls out. Well, where are we? In terms of if I'm already at a multiple of my risk and the stock has run and now it starts to stall, well, that's usually where I'm thinking I can take partial profits, all profits, turn the edge over. And those are things where normally then we're looking at a number of different things. How short-term extended is the name? Because nothing goes up forever. And then, of course, what type of trader am I? And this is where, again, even if you're a swing trader, or people use that terminology, there's a number of lanes on that highway. There's shorter term swing. They want to sell right into that first move, and then there's guys like myself, who I usually want to play something out for at least days to weeks, maybe even months. But I want to then, again, to that point earlier, rather than trying to pick what stock I think is going to act the best, I want the price action to tell me. So the stronger the name is, the more likely I am to try and give it the benefit of the doubt, because price is telling you something. And to me, listen, there's always a caveat to certain rules and things, but as a general rule for discretionary breakout type traders or discretionary traders that are directionally trading with the market, one of the best indicators I have found is that if you buy something and it puts you under very little pressure or just takes off, the market's sending you a signal that your timing's right or it's under accumulation. And I found that the better I've gotten at this, that has been, and the temptation is often to do the opposite. Well, I've got 3 names on and this one is up a lot. I want to sell it, right? Because I got to, and normally it's like, that's the one of the 3 you got on you want to give the benefit of the doubt to. And the mistake most people make is they sell all of that one and hang on to the worst one, or don't take the loss on the worst one of the 3 they buy. And it should be the opposite. You should be selling the one that isn't following through and moving that capital somewhere else, and then maybe only trimming the name that is the most extended at that point. But honestly, it's more of how extended is it short term, and then understanding, again, based upon studying these things, what's normal, what's abnormal. And there are different things, that we look for. And those are kind of little nuances. If a stock is, had the largest move in a short period of time that it's had, say, over a certain period, that's a signal that, maybe you're even getting parabolic or exhausted, or stock goes parabolic. Then we're moving completely into sort of profit protection mode. You can set, and exits for a loss are usually based on one of 2 things or both. The first is an acceptable risk point. To my point before, where I kind of know in relatively short order, is this train coming in on schedule? And that can be just a percentage. And as a general rule, I don't take individual price stops or stop risk on a percentage basis of more than 8%, 8 to 10 being the max. And usually I want to be mid single digits. My long-term average is under 5%. So I'm very tight on, in terms of those stop losses. And then the gains just become a function of my average loss. So as a rule, I don't want to sell a stock that's acting well or less than my average gain if I can help it, because again, I'm managing an edge. And the goal is, so I'm thinking in probabilities, not in tickers and stories. This is this is an edge probability game at the end of the day. We're trading pieces of paper here. I know some people may not like hearing that, but that's what these stocks are. So yeah, the gains then become a function of how do I maintain an edge based upon how often I'm right, and I have to make a certain amount to pay for losses. Now, again, there are technical considerations, and it doesn't mean I just every time I get to 2 times my average loss, I take a profit. But that's where I start looking then for how extended is the stock, how well is it acting, and there's a whole list of confirmations and violations that we watch and go over.
What would you say to traders who get stopped out on a trade and then they look for signals to get back in because they feel like, oh, I know this is going to turn around, and they feel glued to that stock? Or what's your attitude on that? Do you just flush that stock out and then move on to the next one in the list that makes the cut? Do you have to run it back through your process again before you get back in?
Yeah. And well, the reality is, so I would much prefer to take a sort of a tight stop, if you will, and keep the name on their radar versus the other 2 alternatives, which is 1, not take the stop and hold a loss, or kick the stock off and, because it stopped them out emotionally and say, well, I'm not going to trade that name again. Remember, these stocks don't know who you are. They don't know who I am. They don't know your name. They don't hate you, when people say that, this stock never works for me. Well, it may feel that way, but again, that's not reality. So I would say is you need a plan for reentry. The key is that you don't just get enamored with a name and are constantly trading it back and forth just because you want to own it for if or when it goes. And that's definitely a pit that people fall into. So you just if you're going to be a trader who trades with tight stops, you're going to get shaken out. So you have to account for that, which means you need some reentry mechanisms to know, okay, what do I need to see? As a general rule, though, if I get stopped out today on a name, I'm probably not buying it back for at least a day or 2. I'm going to want to see, usually if that's happening, the volatility is widening a little bit. That's what's triggering my stop. So I'm going to want to see it either come back into a range and settle again and then try and reassert itself. We have different techniques we use for trying to get back on board situations like that.
How has your performance been over the years since you started in 2009 through the many different market regimes that we've experienced? And have you found certain market regimes to fit your strength more or less?
What do you mean by regimes?
Oh, like regimes, different types of bull markets and bear markets. Yeah, choppy markets.
Yeah, I would say for me, well, listen, our performance has been quite good, in terms of long term. It's been a function of there are periods where there's a lot to do or we're very aggressive, and there's periods where we do little to nothing. I've had months and months where generally in bear markets, and the bear markets are shorter, and a lot of people will say things like, oh, there haven't been that many bear markets, over the last 15 years, but we've had some vicious declines, things like the flash crash. We had the fiscal cliff decline in 2011. We had a cyclical bear market in 15 and 16. Obviously, the COVID decline was a monster. We had this bear market in 22. So those usually, like I said before, the process helps us just kind of be in cash. We're raising cash well ahead of the major decline. And because the riskiest, or growth momentum areas of the market usually start trading poor well ahead of time. So the hardest periods are often, markets, like you said, that tend to be a little bit choppier, or where we have ideas, but maybe volatility is a little too high, or you're coming out of bear markets and where there's still a higher level of volatility, where it's harder to get positioned with sort of a tight stop, and you get that sort of death by 1,000 cuts. Where and the way we manage risk is, listen, if you were going to knock me out, you are going to have to jab me to death. Meaning, I am not going to open myself up for that, Mike Tyson haymaker that is going to put me on the mat. I'm going to make you, nick me, and you know what I mean? So we're always, and our bigger drawdowns have always come as a result of sort of getting nicked down, if you will. Then the best periods, really have been coming out of corrections and bear markets. Bear markets are the authors of bull markets. And, every time fear and skepticism, pessimism, and everybody thinks the world's coming to an end, on the other side of that, the sun still rises, and it's always a good period. So we kind of look at the more volatile periods, or even bear markets, are sideways, will thrive on the other side. That's been precisely how it's been. I mean, 2011, 2020 was an incredible year. 21 was a great year. I mean, there've been, and again, the other thing is, most people don't understand, even really good returns, they're generally not linear. They sort of come in bunches, and you break out and have a meaningful, advance, and then you kind of go sideways or mark time, and then you go, rather than, if let's say you do, 40% compounded over time, it's usually not just 2% a month all the way up. It's like you go in spurts, and the key is obviously trying to make big advances and then wall off the risk and try not to give a lot back. And that's sort of been our calling card.
Did you ever have pressures of performing like your dad, Mark Ritchie Sr.?
Certainly, maybe early on. I could tell a story there, just real quick, because I remember asking my dad. I said, "Well, what should my goal be, or whatever?" And he said, when your account's small, you should do somewhere between 200 to 1,000% a year until liquidity and volume becomes an issue. That was sort of his metric in terms of performance. Yeah. And this of course is a floor trader's mentality also, where there's very little, how shall I say, real-time risk control, where a guy can put on, because he's standing in a pit, way more size than any broker would ever allow you to do, in a situation. But where in his mind, it's like, well, if I know I have an edge here, so a little bit of a different mentality, where I kind of knew early on, I was like, look, Pop, the gunslinging days of the 70s are over. It's not that you can't, do very, very well. And also he was certainly for a majority of his career, an individual operator. So if you're managing even a little bit of, somebody else's money, or it's just a different mentality, sort of being an individual trader than even having we manage a small pool of assets that we've always managed. So you have to be more cognizant of even your own volatility in a situation like that.
Excuse the last interruption here. This is Tessa. We hope you're enjoying this episode so far. If you love the podcast, please give Chat with Traders the best review you can on whatever platform you're listening from. This one
and now different things. It's harder than ever. I think around again the things that at least I'm looking at, and the things that the things that we talk about, I think are timeless. These type of pattern situations they've been going on for as long as markets are here, and they'll be happening long after we're dead and gone.
Well, Mark, thanks for coming on Chat with Traders.
Yeah, and can I just add too, for those who are interested, we do a seminar every year on this. You can go to 4 Stock Traders, where we sort of unpack this from A to Z. That's a seminar I attended myself. So I'm a guest instructor there with Mark Minervini. But for people who want to learn, listen, is there a process where I can identify some of these big winners beforehand and studying all these past precedents? There's a 500 plus page workbook. I learn more every year, even though I'm teaching it, and there's a really good community at Minervini Private Access. We kind of look at the seminars like a flight school for people who are interested, and it's a major commitment, but it's a worthwhile investment for people who are really interested. So yeah, it's the number 4 stocktraders.com if you're interested. And then, like I said, we also have you can go to minervini.com if you want to learn more, or check out one of Mark's books. Those are if somebody was to come to my office, that's what I'd hand them. And that's what they'd see me doing. So yeah, for anybody interested, or you can follow me on X platform as well, _Mark Ritchie, or Mark Ritchie number 2, Roman numeral 2.
Okay, fantastic. So great. Multiple ways for our listeners to get in touch with you. Great. Thanks again for coming on the show.
Thanks for having me, and it was a lot of fun.
You've reached the end of this episode of Chat with Traders. But rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes. And we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers open the doors. Mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based, making it truly worth your time and effort. Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Trading in the financial markets involves a risk of loss. Podcast episodes and other content produced by Chat with Traders are for informational or educational purposes only and do not constitute trading or investment recommendations or advice.
I lost $500,000 in one day. That was because I was pushing massive size, but I should be pushing massive size. If I didn't do that, then my 10K might have turned to 50 or whatever because my risk tolerance is so low. But at the same time, there's kind of the balance, because if you're like, well, screw this, I'm going to mortgage the house and, let's just go crazy on this. And then you have some black swan event, you see. So there's the temperance that's needed, but it goes both ways. You can be ultra conservative and sort of the paralysis by analysis type thing, and you never want to take the step because you're so scared. Or you can be a wild outlaw that gets beat up by the law too much because you're doing crazy stuff. I don't think it was too far after making $500,000 like in a week. There's anomalies that have gone to the upside and to the downside. And this is where the discipline is required, is the data said that $500,000 loss should have happened. There was no break in the model.
Markets, speculation, and risk. This is the Chat with Traders podcast.
Hi, this is Ian Cox, your host. Thanks for tuning in to Chat with Traders. This is episode 291. My co-host, Tessa, is enjoying her vacation somewhere sunny. Well, we've got a great episode for you today. I'd like to introduce Sam Meese. When Sam worked for a tech company, he saw firsthand how predictive analytics boosted sales. He eventually applied that idea with quantitative analysis in the small cap market, spending nearly 2 years collecting data and observing how money moved into and out of small cap stocks convinced him that there were repeating patterns which could be statistically exploited. After many backtests, Sam finally had a system which processed over 10,000 small caps and produced 20 to 40 actionable daily opportunities. Starting with an experimental $10,000, his rigorously backtested system gave him the confidence to stick with the signals despite suffering a $500,000 daily drawdown along the way to growing his account to $3.8 million in less than 3 years. All right, let's get straight to my interview with Sam. Well, Sam, I'd like to welcome you to Chat with Traders.
Thank you.
Yeah. So where are you at now?
I'm actually currently in Idaho, but I'm not 100% sure if that will be a permanent location right now. So there's some in between. There's some transition going on. So, but I did come just before this from Puerto Rico. So I was in Puerto Rico for a decent chunk of time, but that was just a little bit too hard on family. So we're back stateside trying to figure out where we're going to land. So.
Oh, great. Well, let's dive into your background. Kind of where did you grow up, and tell us a little bit about your early interests and what drove you as a person.
Wow. Growing up, I was a quiet kid. I was the kid that's always just sort of taking it all in, very, very observational, very analytical, and just kind of grew up with that sort of temperament. I was one of 7 kids, and I was at the tail end of that. So I had the privilege of watching all my siblings grow up and mess up and succeed, or, there was a lot of wisdom intake that you can get when you're that far down on the totem pole. So I always felt a little bit out of my element, frankly, as growing up in terms of, to the left and my right, my peers, I never really felt quite in the same company. So I was always sort of looking ahead and wanting to grow up fast and always a very curious mind. With that analytical mind, I got into tech as I became an adult, and still love technology. I was always the kid that loved the wizard class of characters, and technology is really the closest thing to having wizardry powers. So I love tech. I develop on the side, and have some projects in the dark right now, but that I work on. So I really, really love that. I did, to bring it all the way up to current, I did get into enterprise tech sales for a time, and that was really enjoyable. And that's actually a sort of the launching pad into trading, because we were selling data science products that did predictive analytics. And so I was very fascinated by that and wanted to apply that to the markets. So anyway, quick story of the upbringing there, all the way up to.
Yeah. My understanding is you got in a little bit early into entrepreneurship. And tell us a little bit about that.
When I was in my 20s, I was always trying something. So something crazy and many, many failures. But I did get into the consumer electronics space, which was one of my earlier wins entrepreneurially. And I had a business partner at that time, and we were 50-50 partners. And that's not a wise relationship. I think somebody needs to be 51, or somebody needs to be the chief. But we did grow quite a bit, and we were basically buying and selling used electronics, iPhones, iPads, all sorts of things. And the company grew pretty fast, probably too fast. But so that was a decent entrepreneurial win in my 20s, and that didn't quite work out. And then I got into tech sales for a while, project management, and a little bit of pseudo engineering, and did that for a chunk of time. And that was very, very formative, and I loved it. It was a great challenge. So, and it was good too, because the company that I was working for at that time they were growing, but they still had a lot of startup culture. And I'm not one to do well with a lot of red tape and stuff like that and restrictions. So thankfully I was allowed a lot of latitude to do what I thought was most helpful for the company, and could still kind of satisfy the entrepreneur in me, but always trying some side hustles while I was still there. And one of those took really quite well, which was this trading journey, particularly a quantitative approach to the markets. And that was in like 2019 was when I launched the fund.
Mm-hmm. So what triggered your first early interest in the financial markets?
So I'm a rags to riches type story. Like, I came from nothing. Mm-hmm. So I'm really, really nothing. So I had to start from scratch, and I have a lot of ambitions and a lot of desires to grow a lot of things. But when you're in that position, the first problem you have to solve is the money problem, frankly. So I knew that I needed to get capital to form a cornerstone to all of these other longer horizon, longer time frame things that I'm seeking to build. The stock market's fascinated me. I mean, sure, just sheerly by the fact that, I don't know what it is today, but I think it's like $250 billion of value is exchanged every day. And it's such an insane amount of value that's changing hands. And if you can find ways to just skim a little bit of that, then you can be, quite wealthy from that. So, that was really the pure drivers. Like, I have a lot of ambitions. I'd like to build a lot of things, but I got to establish a nice, healthy capital base. And the stock markets caught my eye more than anything as an expedited path to that.
So did you just save up money from your regular job? And if so, when did you open up your first account and make your first trades?
I did quite well in the tech world and had a little bit of extra money, not a lot, but a little bit extra money to play with. And so I took a small amount, I think in 2016, and I started sort of discretionary trading and just kind of messing around, particularly in the small cap markets. And that's just because that's where most of the volatility is. And I mean, as a trader that's looking for outsized gains, you need extreme volatility. So I targeted there, discretionary, didn't really know what in the world I was doing. Kind of paid my market tuition there, lost some money 2016, I think in 2017 as well. But it was during that time where I'm just sitting in front of screens and studying for hours and learning all of the intricacies of the markets and learning how to read tape and level 2 and just all of the nomenclature, all the vocabulary, just basically acclimating to that world. And that was when I really started to recognize repeating, just observationally, I started to recognize these repeating patterns that were happening in that, at least that segment of the market. And it was so repeatable. And then tying that with the fact that I was literally selling predictive analytics, a little bit of machine learning with some of that on the back end, but I was selling products that would predict human behavior. And the markets really are just an expression of the human spirit, the collective human consciousness, you might say. Like it's just a window to see that. And human beings are very, very predictable. They do the same thing again and again and again. They're motivated by the same impulses. And so all that to say, like, as I was doing this discretionary trading, I'm seeing these patterns, I'm seeing these things that very clearly, anecdotally at least, are repeating. And that's really what where it got in my mind to the thought in my mind to try to quantify that behavior.
So these repeating patterns, were you so you were just focused in on the small cap market? Is that correct?
I flirted a little bit with some other segments and large caps, but I needed to be where there was volatility and pretty regular volatility. Plus, I was also wanting to, like, and then it's one of my filters for how I trade, at least, is I didn't want to go toe to toe with heavy institutional involvement. They're just well capitalized, and the brightest minds are in those worlds, and so it's hard to compete in that if you're under resourced. So I try to stay away from stocks that have heavy institutional involvement, and I also need that volatility. So and that's where small caps really, really showed the promise there.
So what kind of repeating patterns did you see? Like what showed up?
Well, that's important. There are abstracted principles to quantitative trading that are universal and aren't revealing of a specific edge. There's some debate among, I don't know why there's even a debate because it's so stupidly obvious to me, but there's some debate as to whether or not edge erosion is a thing, but it definitely is. So I'm not going to share like the exact specific edge, because then you just get piled in. And I mean, to be an edge is to not be popular, right? It's to be marked, it's to be distinguished. So I can't say exactly what that is, but I mean, I would say that any of the commonly believed patterns, I guess, or patterns that are seen in the markets, like cup and handle and double tops and reversal patterns or whatever. Like there are a lot of things that are already recognized, like, and sort of standardized within the trading world. And those, I would say, those are very worthwhile. They are worthy of closer looks, I would say. Like, they're definitely worthy of going deeper and seeing if this is something that could be predicted. There could be earlier indicators that could show that this is what it's going to do after this pattern presents itself. But yeah, there's a lot of variables that I definitely consider when I'm qualifying a specific stock. But I would say that it starts with screen time, and it starts with just anecdotally, observing these patterns reoccurring again and again, and then from there get an idea and then try to quantify it.
And how did you go about the process of quantifying it and getting the data and processing it?
Yeah, so I was manual. So and I think that's still common. I did look at some sources, and I couldn't quite find like clean enough data. So there were too many anomalies, and I was struggling to reconcile it with. There was just, so I manually pulled it, and I actually just used Thinkorswim's on-demand features to look back at historical data, which is a really, really valuable tool. And I just manually recorded all of the data, thousands of rows in spreadsheets, and just mined it, just swinging the axe. So, I mean, I could code, but I didn't find that super useful at the time.
So were you kind of learning about statistics on the fly, or did you have a background in that?
I mean, I'm an entrepreneur, so I want to like question the premise of that question even because I'm not big on certifications or
Right.
even a lot of training. I think is frankly a lot of waste. So no, I don't have any background in statistics or whatever. But I mean, you can learn anything. Like you can learn any, especially today with AI. I don't even know why we need education, frankly. Like, I mean, these new models are PhD level in terms of the knowledge they give back. So I'm just a very curious mind. I'm very determined. I'll study on my own and I'll figure it out. So I didn't have any background into that, and I wouldn't say that there was. I mean, there's like a mathematical equation or whatever that you can run that proves whether or not something is statistically significant, but you can also prove whether or not something's statistically significant just through common sense. It doesn't really, and that's the beauty of quantitative trading is it actually is not as complicated as most people think it is. Most people think this is rocket science and it's crazy physics or who knows what, they think it's, and then they have self-doubt because of that and all sorts of problems, but it's really just common sense. It doesn't require any expertise or any long form training I would say is not really required.
How would you define quant trading in the context that you're in?
I think it's helpful to answer that question by defining the opposite, which would be qualitative trading. And qualitative trading is very subjective. It's very much, I like the CEO, I like his vision, I think he knows what he's talking about, or I like the way they're managing this operation or whatever. Like it's just a very subjective feel that you like the product or you like the company, and so you're going to buy the stock. Whereas quantitative trading is completely agnostic to many of those. It doesn't care. It doesn't know about them, doesn't want to know about them. It literally just looks at a filtered company and it tracks what their performance has been in the past. And then the variables that are involved in there that sort of like brought that performance to fruition. You track those variables, you sort of try to wrap the behavior in data. And then from there, you start to run some predictive type analytics. Okay, here's all these, it's just like big, long, if then chains, if this, then that, if this, then that. And that once you find something and you're like, oh, wow, I just ran the numbers and this thing happens 70% of the time, that's substantial depending on your sample size, of course. So in terms of how I define quantitative trading, I mean, it's basically trying to use as much mathematics or statistics or whatever, just data as possible with little to no subjective calls about whether or not to put on that trade or to sell. So it really should be as much as possible. The computer is telling me to do this, and so I'm going to do it.
Did you ever have to hire a programmer to automate your systems, or was your system manual, the execution of it?
So I looked into developing and automating some of the actual entries and exits and execution, but I decided, I would say that the model that I built is probably like 90% data, maybe 10% subjective. So maybe not even that much. And here's an example. So, and I don't mind sharing this. My model, like one of the first filters, one of the higher level filters, and there's a few different levels of filters that the stocks will go through before it, ends up on my desk, so to speak, and I got to do something with it. But the highest level filter would be gapping stocks overnight. But sometimes you might have a stock that gaps 100% or whatever, like that the data is saying, hey, here's a stock that's gapping a lot, and that passes that filter, but it's like a buyout or something like that, or some weird news thing. And so you look at the chart and yeah, it has jumped up 100%, but it's a flat line, overnight. So it's not actually the qualified stocks. So that's a very hard thing. That's an anomaly that's hard to program. It's hard to like account for. So to answer your original question, I have certainly looked into that, and I know that's possible. And I know people have been successful with that. And it's something I might revisit. I don't know, but right now I use software to sort of distill what I'm supposed to do down to like, here it is on your desk, and then I will execute. Still following the plan, like still following what the data tells me to do, but I will enter and I will exit. It sort of tees up the ball and it's really teed up. So, but I still got to swing. So I have not fully automated my particular system.
And how long was this process to discover a statistically beneficial plan? I mean, a program that you can execute.
Yeah. So I started, I think in 2017 is when I started collecting data. And now I was also working at a very demanding job as well. So I didn't have like full bandwidth to give to the data mining and the curation and analysis and all of that. So I think it took like maybe, it was probably like 1.5 to 2 years during that time to build. And that's the really hard thing about, this is probably where most quantitative traders fail, is it's like you're approaching a mountain that promises gold, but there's nothing on the outside. You can't go up and grab it. You have to have like this crazy delusional self-belief that I'm going to keep digging into this thing to get some value, and it almost has to be delusional, because you're going against quantitative trading. Proves most, I don't know what it's taught now, but my understanding is efficient market theory is still kind of common doctrine in economics, and quantitative trading completely proves it wrong. Like it actually flips it on its head. So you got to be delusional. But the challenge is, once you start digging, you might dig 100 feet in and you have this great idea and the data says, nope, it's not true. There's nothing here. So it feels like you wasted so much time just eliminating that as an idea. So the proving out of your ideas is extremely tedious. It's very, very difficult. And I don't think a lot of people can really stick through to the end. But if you can, it is there. Like there are statistical edges that you can find in the markets to give you ridiculously outsized returns. It just takes a ton of work to actually do that plowing through to get to the diamond. So yeah, I mean, it probably took me 1.5, 2 years to build the model. And then once I found it, I was like, this is really crazy if this is true. And so I built it. I actually taught, my wife doesn't know anything about trading, but I actually taught her to execute the model because I was traveling all the time and working. So she executed it, not knowing anything about, and that's what I mean by it's only 10% subjective, because she didn't know anything about stocks, but the subjectivity didn't matter. It was very, very much just do this. So,
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with 0 locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
I see. So you boiled down the model so that it was just simply, buy this stock or sell short that stock, and so it was easy for someone that. Did you have to train her a long time to do it? Was it simple
maybe
enough?
like a week. So I built the model and I showed her when it will tell her to execute, and this is exactly what you do. And I mean, it was really, and again, she could follow that very well, and it wasn't demanding on her time. She had free time to be able to do it.
Do you feel that your entrepreneurial mindset helped you stick through the process? Because that's a long time, because you didn't necessarily know when you would find something statistically relevant, right? I mean,
yeah,
you could keep going for who knows how long.
Well, yes. So here's what I would, and I approach this, and this is why I preach self-confidence so much on this. I approached it with some certainties in my head. I was very certain that I was seeing things that kept happening, like very, very certain. And I was very certain that human beings were the cause of it, because the markets are just an expression of that. And I was certain that if you get the right variables and you get the right data that's sort of like strings attached to the masses, you might say, and if you can figure out what those strings are, then you can measure it. So you can use those strings, those sort of levers that are stuck in society and behavioral economics type stuff. You can use those to measure the behavior and then predict it relatively decent. You can predict the future. I mean, quantitative trading is predicting the future. That's really what it is. So, and it's crazy. But I will say that to answer your original question, I am a very, very weirdly determined individual. Like I will not stop something unless like God stops me, basically. So it has to be like a really, it's not just that the front door has to be shut because I'll kick it down. It's got to be like a brick wall. I can't get through. Like it's got to be something so I'm extremely determined. But I will also say too, I mean, I was selling products. Like we were selling products that knew your purchase history as a consumer and knew that there was an 80% chance that if you go to McDonald's and you buy an Egg McMuffin on Tuesday at 10 a.m. and you're a white male in his 50s, then we need to show you a black coffee because you're part of a group of people that behave similarly. And there's a 70-80% chance that if you buy that Egg McMuffin on that Tuesday and you're a white male in your 50s, there's a 70-80% chance that you're going to want a black coffee. So we're going to do that. So it's like I was already selling these things, and it's Minority Report type stuff. It's real. It's very, very real. So yeah.
Wow. Okay, so let's get into once you found a statistically relevant model for you to trade through. How did you start trading, and how much money did you start out with?
So I was under. I only when I traded in 2016, 2017, it was very much discovery and testing and getting my feet wet. And so it was like I didn't even put enough to be over the pattern day trader rule back then. So it was a different broker at that time. But then when I was serious about it, I switched to a larger broker, and they to get over the pattern day trader rule and start executing this model. And so I think I put like 35,000 or something like that in an account, but I only risked 10. So I exposed 10K to risk. And that was at the end of 2019. And then I had my wife start executing it. And so in 2020, it grew, I think, like 800%. It went from $10,000 to like 86,000 or something like that in 2019. So, which was ridiculous returns.
Wow.
And so then after from 10K to 86 or whatever it was, in 2019, we kept that same 86K on. We didn't withdraw anything. And then 2020 came, which was something that I don't think will ever happen in our lives, probably with COVID and sports betting was dropped. It was shut down. Everybody's got stimmy check. There was so much money in the system. It's insane. So all of that money in the system sort of just gave fuel to the model. Like it basically the model was working, and now it's been supercharged, like a turbocharge, and all of this juice is flowing.
So just curious. So in the first year that you had that incredible return, what exactly were you were just trading these small caps?
Small caps, yeah.
Long, short, or?
It was short. I could say it was short. Yeah. So it was. I was short selling moves that were, you might consider, parabolic. So looking for hyper extensions, basically, is what it was.
Okay. Wow. And how many trades did you do that year, if you can remember?
I think it was like 400 round trip.
Oh, okay.
Yeah, something like that. Qualified and was executed somewhere around there. So it was and I had built the data. The data that was collected was from 2018, 2017, and a little bit of 2016 was my sample size, which was decent. Like, it was a decent sample size. So, but yeah, I think it was around like 400 trades, but I think it like doubled at least in 2020, because that 86K went to like 2.2 million.
Wow. So, so you're finding things to short one or two stocks every day almost, right? I mean, and how long are you holding them for?
This particular model is only intraday, so I don't have to swing any trades. So, which is nice, because this is a very scary thing. It's a very scary thing, especially if you're short selling, to hold overnight. And then there was one recently, I can't remember the ticker, but it just went bonkers overnight. I feel really bad for people that are stuck in that. So that's nice on the heart. But yeah.
Did you have to deal with borrow fees if you're trading intraday?
Yes.
And locate fees?
Definitely give a lot of money to that. I mean, it's ridiculous how much money I've spent on locates. I don't like to think about it.
Oh, okay. Right. Okay. So you had this fantastic year in 2019, and then 2020, did you take any money off the top? Because you had such a fantastic year the first year.
Yes, I did. So 10K to 80, whatever it was, K 2019, that 86K, I think it was, then grew to just over 2 million in 2020. This is the other issue too, is there are constraints, that you can't really resist. You can't go further than them, and liquidity is really the big constraint, and that's one of the things that makes quantitative trading quite challenging. Is let's say you build a model and you discover an edge that says, hey, if you have a stock, and if it dips at the open by 20% or something, there's an 80% chance that dip will then spike back up if it holds some sort of line, whatever. So if you did that, and it says if that trigger happens, you have to buy the stock right at 10:30, I guess we'll just say. If your data is saying it has to be within that 1 minute window, or even smaller, it could be seconds, that you have to enter, then that's when you got to go. So if you're trying to buy 10,000 shares, that's one thing. But if you're trying to buy 100,000 or 200,000 or 300,000 shares, well, you're going to get to a point where you are moving the market in that instance. And so you're creating something that's actually outside of everything you've back tested, which is why edge erosion exists, because you have a liquidity problem. So I had to basically cap out in 2020, and we did take some of those earnings, and we went to Puerto Rico too. There's tax benefits there, as I'm sure you know, for finance. We basically hit the liquidity cap, and then had to withdraw, take stuff off the top when it got over that. So,
does your model actually then, the way I understand you're saying, actually tell you like a time window to get in, or kind of parameters to execute, or simply does it process it the night before, and then you get a buy, you say, okay, go long or go short, and then you decide discretionarily, like when during the day to do it, or it's providing you within a time window?
Yeah, it is a very specific time. Yeah. Mm-hmm. So it's the only discretion that is used is whether or not it truly qualified in the filter. So it goes through two or three, at least how I have it set up. It goes through two or three different filters. And then there's the subjective piece of maybe you're looking at 10 stocks or 20 stocks. Now you just manually check the charts. You manually look and see if this is a qualifying stock. And then you wait for the exact time that you're supposed to get in. And for me, that is within a minute I could share. So I've got to make sure that my size isn't too big that I'm going to, screw up my entry or my exit. So, but yeah, the discretion is related, which is very small, but it is related to whether or not they've truly qualified. It's not related to, do I execute now or whatever. Once it's qualified, then it's just follow the script from there on out.
I see. And you mentioned that you have to avoid your size being too big. How do you determine that? Like give us an example. What percentage of the daily volume, or what are you looking at?
Yeah. Well, I mean, I don't have that really super systematized for how to handle that. I just felt it basically.
Okay.
So I noticed, oh man, I just totally moved the markets there, and my slippage is now noticeable. So it's almost like a glass ceiling, and there's not, if you look up, that you can't see the glass. So it's hard to know when you're actually touching it. You just kind of have to feel it. At least that's how I've done it. I'm sure there's probably some other ways that to handle that, but I let the account grow. And what I do too for the account is, particularly when it was really small, is I would just keep reinvesting. And so my risk would be increasing more and more and more every day. So every day I was resetting risk, whether it was down or up, I would reset risk based upon the account size. And so as it continued to grow, and now I'm doing hundreds of thousands of shares, that's when I started like, oh no, I'm touching the glass ceiling now. I can feel it. I can feel that I just moved that. I can see the wick right there. That's me. So for me, it was just feel. But maybe there's a way to wrap that and, quantify that in some way. But
so the small cap universe is quite big. Last time I checked, it's in the 10,000, more than 10,000 different companies, right? Typically, how many stocks are you working with on any given day that get filtered down, that make the cut?
I would say that get the stocks that get to my desk to then be subjectively looked at is probably 10 to 20 on an average day. Busier markets, maybe double that, I would say, which can take a little bit more time to qualify. So, and then in terms of how many I actually execute out of that, 5 and under on average. If I'm 5 or over, then that would be a very busy market, which does happen. It happened in 2020 a ton. 2020 was insane. So that's roughly like the numbers that get to me for subjective calls, and then that actually do finally qualify to be traded. And then I just wait for the timing to tell me, which has already been computed, to here you go ahead and act now. So
I see. So do you use stops, or do you manually exit?
I do use hard stops, and then I do manually exit as well. So and even the hard stops too. That's the thing that makes me scared about giving everything to an algo. Is I've watched with my own eyes stops be set, and then they just don't trigger. And that's especially if you're trading a model that's short selling, terrifying, because there's no end. I mean, you can owe money in short sell, like you can lose a lot. So if it doesn't trigger, then I'm that's super dangerous, and I've watched that happen. So, but I'll have a hard stop, and I definitely recommend hard stops, and the data should tell you where that is. So set your hard stops, but still watch it, make sure it goes through. But if I don't need to do a hard stop and it's a winning trade or whatever, then I'll actually just execute that. And on my exits, at least for this particular model, I don't have to be like super precise within like seconds. So I can make sure that I'm not dumping all the shares at once, which will give me bad fills. So I can sort of manage that on the exit.
Did you encounter any trading psychology issues trading this way, or you sleep like a baby each night because you're not in the market?
Well, yeah, I mean, the overnight's nice. There's definitely fears there. I mean, the trading psychology is everything. It's so important. It's so important. And that's really what initially what drove me to the quantitative approach is I want to get rid of that. I want to get rid of, I mean, it's a weakness in us. It's every man's battle really, is to try to control those impulses, greed and fear or whatever. So definitely felt that during discretionary play around time, whatever you want to call that. But then I was like, I'm going to get away from this and I'm going to let the data tell me what to do. And that was super helpful. But there's other fears with those types of things because, and I'd say probably this might be one of the biggest fears for a quantitative trader is you do know the future to some degree, but you actually don't know if an edge will be around forever, when it will die. You know, those are really unknowns. And so you might find something that's like amazing, you know, but you don't really know how would this behave during like the Great Depression, or how would this behave during the housing financial crisis or the dot-com boom, you know, or with AI or with large language models, you know, starting to penetrate markets more. Like you just don't know. You really don't know. And there are always people who are trying to find the edge, and then that will flatten it and it will make the markets efficient. So those are the biggest challenges for quantitative traders, and those are fears that you can have, but there's ways to mitigate that. But yes, to answer your original question, it's definitely nice that I don't have to, at least this model, I don't have to swing trade. So that helps a lot for sleeping at night. And it also helps a lot too for the crazy discretionary traders that I don't even know how they exist. Like it's just so stressful. I mean, the scalpers and those types. Those are very, very stressful positions.
How did your model perform in the years afterwards when we had a market regime change and, you know, markets started to go down and liquidity started to dry up, at least in the small caps? Yeah. How did your model fare then? And did you have to make adjustments?
Well, I'm sort of considering that at this point. And so when I had this big run up, which was just insane, where from 10K to 3.8 million is what it ended up at the end of 2021. And then I moved to Puerto Rico and met like amazing people there at incredible, just massive life changes in really, really good ways and really, really, you know, challenging ways just because it was all new at the same time. So, but after I had that big run up, I sort of pivoted and I went hard into learning game development and pursuing some AI projects as well. And so I still had this model just like activated.